Are you thinking of getting involved with rental properties? Are you looking forward to the wealth and passive income that rental properties can bring? Well, hold on one sec.
The cost of renting versus buying a home comes up all the time. What is the better financial decision though? With renting, the total cost is just the amount that you give your landlord that you never see again. So for example, if your rent was $2,000 a month, multiply that by 12 months and you have $24,000 a year that you just never see again. The total cost of owning a home, however, includes a mortgage payment, which is comprised of interest and principal, as well as miscellaneous costs like maintenance per year. So to make an apples to apples comparison, we need to figure out how much money we'll never get back again in both of the scenarios. This original take and unique angle was first presented by Ben Felix, a Canadian portfolio manager here on YouTube.
What actually is a rental property? Is this like a commercial property? Is it a condominium? Is it a townhouse? Is it a single family home? Chris, what do you actually mean by rental? Well, according to Investopedia, residential rental property refers to a home that's purchased by an investor, but it's inhabited by a tenant on a lease or other type of rental agreement. Residential property is property zoned specifically for living or dwelling for individuals or households. It may include standalone single-family dwellings to large multi-unit apartment buildings. Bottom line is, you're about to buy some real estate, you're planning on holding it for a while, you've got to rent it out to a family or for a tenant so that you can actually make some money and hopefully a profit.
Now, Ben states that there are three components to home ownership and figuring out this whole monthly cost of calculation here, and that includes property taxes, maintenance costs, as well as the mortgage payment. The mortgage payment will be broken down into two different components, which we are going to discuss thoroughly today. However, all of these costs are associated with home ownership that a renter will not face. First, we need to talk about property taxes. So property taxes occur on any property that you own, and basically what it means is by owning that property, you must owe the government or the state that you live in a certain percentage of the property's value in taxes every single year. In the United States, the average property tax rate is 1.11% across all residential real estate. So we're going to use that number in today's example. And we're also going to use the example of a $500,000 home.
Awesome. So let's help you get there. I'm going to use this video to give you the basics, the foundation for rental property success. I'm going to do it in an 8-step process. Number 1, make a plan. Look, there's a ton of different types of rental properties out there. There's single family homes, small multifamily properties, large multifamily, commercial properties, vacation rentals, and so on. So it's good to narrow that down and pick one type of property you want to start with. You don't have to be stuck with that property type forever, but just focusing towards one thing, you can dig in deeper, read more books on that topic, listen to more podcasts on it, chat with other investors who are doing that kind of thing. Get clarity, get focused. All right, step number 2, choose your market. Look, you don't have to invest in your own backyard, but when you're first starting out, it definitely makes it easier if you can drive to the property. But again, you don't have to. Invest where the numbers make sense with the plan that you've made. So if you're looking to buy rentals, but you live in downtown San Francisco, then you might need to consider a market further away. Some areas just don't work as well as others. Then, once you define your market, it's time you do your homework and seek to understand as much as possible about that market. Where do people like to live? Where are property prices higher? Where are they lower? What about rent? What about crime? Talk with local real estate agents, talk with lenders, talk with property managers, other local investors. They can all help you in a tremendous way. And that actually leads us to step number 3, build up your real estate team. Now, when I say team, I'm not talking about some like high school jock squad, right? I'm talking about the professionals that you can help, that you can rely on to help you with your investments. Specifically, I want to call attention to what my buddy David Green, author of Long Distance Real Estate Investing, calls the core 4. These 4 people are like the people who are going to help you the most. Your agent, who can help you find deals and understand the market. The lender, who can make sure you get the best financing possible. Your property manager, who can advise on the best neighborhoods and rental rates and property conditions. And your contractor, because if you plan to buy something that needs to work, which most of the best deals do, you're going to need a good contractor. All right. So what's the best way to find your core 4? Well, one word. Recommendations. Find some other real estate investors out on biggerpockets.com. There's like 1 million people there, right? And reach out to them. Build relationships. Ask for recommendations.
When you buy this house, someone's got to put some money down to get it. It might be yours, it might be a partner's. Here's the question. Have you secured a down payment? I'm not talking about even the loan, like pre-qualifying. I'm talking about there's hard cash that you've got to put down on the property. here's what you should know. Investment properties generally require a larger down payment than do owner-occupied properties. In other words, an investment property requires at least a 20% down payment. A primary residence, you can usually get away with as little as a 3% down payment. For example, remember this house here, $200,000? I need a 20% down payment if I'm not buying it to live in myself. And 20% of $200,000 is approximately $40,000. So 10 grand, 20 grand, 30 grand, $40,000. This $40,000, where could it come from?
There are some important considerations we should talk about that don't involve the math of buying a home as well. The first flaw that I see is that humans are often irrational and oftentimes impulsive. Like, there are times that I know that it's not a great idea to buy a $7 latte, but I go ahead and splurge on it anyways. Just because there's an opportunity cost consideration of your capital, it doesn't mean that if you don't make that down payment, that the renter is gonna take that $100,000 that they might have and invest it perfectly into the market and capitalize on their opportunity cost. Basically, investing takes a lot of discipline, and you also have to play pretty perfectly. Who's to say that that renter is not going to take that down payment and go ahead and just put it all on black? Maybe go make it 21 red. I don't even know what I'm talking about at this point, but you get the idea. Humans are irrational and not always perfect. So there is that. And then also I view a mortgage payment as almost a forced savings method because you are accruing equity while you pay your mortgage payment. That's gonna be a really good thing for a lot of Americans out there who are not very good at saving in general. So on that topic of building equity, today we talked about the cost of interest as simply being the mortgage rate times your loan amount. In actuality, mortgages don't work like that. Mortgages are on what's called an amortization schedule. That means at the beginning of the mortgage, you're actually paying less in equity and more of the interest up front. But as 30 years progresses of that mortgage term, what actually happens is that you start to pay less in interest and more in equity as the mortgage goes on. So basically, it's at this point I've kind of realized that your cost of equity and your cost of debt are always changing because of the variation of the amortization schedule. If you pair that with the fact that, hey, there's also 15-year mortgages out there, there's different types of variable rate mortgages out there, then we have a lot of variables that we are not accounting for in today's simple rule.
Start analyzing deals. Now I want you to remember 3 simple words. Math overcomes fear. The more comfortable you are running the numbers, the more confident you'll be pursuing deals. And here's the great thing about real estate. Every property out there has a number that makes it a good deal. Your job is to simply find that number and then pursue it. You know, if your goal is $200 a month in cash flow every month, then figure out how much you can pay for that property to get $200 a month. It's really that simple. You might have to look at a whole lot of deals, but real estate is a numbers game, so keep at it. And for the easiest, fastest, most complete way to do the math, check out the BiggerPockets Real Estate Investment Calculators at biggerpockets.com/calc. Offer and negotiate. Make your offer, including how much you want to pay, when you want to close, what kind of financing you plan on using, what kind of inspection period, how long you want that to be, and so on. Your real estate agent can really help with all of this. Now, one trick that I often use in my own investing, I like to give sellers a couple different options, like $200,000 as is, $220,000 if you include the furniture. Now, I don't necessarily need the furniture or whatever else I'm asking for, but if you give multiple options, people tend to choose between the options rather than thinking yes or no. So then once you get that, you're gonna negotiate with the seller back and forth, and either you can't come to an agreement, you'll go separate ways, or you'll get mutual acceptance on the contract.
I think you're ready to buy your first rental property, but not until you've asked yourself this question. Do you have landlord insurance? Chris, what's landlord insurance? In addition to homeowner's insurance, which is required, by the way, when you buy a property, because like if it burns down, the insurance company has got to replace it, the bank requires that. Consider purchasing landlord insurance. This type of insurance generally covers property damage, lost rental income, and liability protection. This is for people that say, all right, Chris, I want to buy this property, but I'm afraid that the tenant is going to destroy the house. I'm afraid that they might lose their job during this strange economy and they won't be able to pay the rent. Chris, I'm afraid that something bad could happen on that property. Like what if they have a meth lab or they invite friends over that slip and fall and crack their head and Humpty Dumpty can't be put together again. I think this is super smart for people that are going to lose sleep at night. If you're new to the game, and paying this extra $20, $30, $50 a month will help you feel better, then do it as long as you have the positive cash flow.
Close and manage. You're likely going to use a title company to do all the paperwork and the details, but you'll probably want to hire an inspector to check out the property's bones, line up insurance, all that stuff. After signing papers and getting the keys, you're going to be the brand new owner of your own personal ATM machine. But that ATM machine is going to turn into a bottomless pit of woe unless you manage effectively. Landlording is a skill anybody can learn. In fact, my wife and I wrote a 100,000-word book on that topic because these things don't come always naturally. That said, I don't even think you necessarily have to manage yourself. In fact, if you hire a great property manager, then it's their job to deal with the difficulties of tenant relations. But remember, it's still your job to watch over the manager and make sure they're doing a great job.
With mortgage rates being so high in the United States as of right now, it really looks like renting is going to be much more appealing than owning a home, especially in the short interim period. However, if you're planning on staying in a place for more than 5 to 8 years and you're actually buying a home, I think that actually has the greatest potential for the most amount of upside in terms of an investment.
Look, financial freedom through rental properties is entirely possible, and you can do it. So get out there today and start building your real estate empire. If you like this video, make sure you subscribe to our channel and click the little thumbs up button to let the internet know you liked it.
And let me know what you guys thought in the comments about the renting versus buying situation. And I'll see you guys in the next video.